On December 11, 2024, New York Community Bank announced massive commercial real estate losses, triggering a 45% stock collapse and signaling the beginning of the regional banking crisis that will accelerate into a full housing market collapse by August 2025. This wasn't an isolated event, it was confirmation that the 18-year housing cycle has reached its mathematical breaking point exactly on schedule. The cycle works like this: 14 years of rising prices, 4 years of decline, then the pattern repeats. The 2008 crash ended exactly 18 years after the 1990 real estate recession. The current bubble that began in 2012 is now in month 146 of 216. We have 8 to 12 months before mathematical impossibility forces the crash that will make 2008 look like a practice round. But here's what makes the August 2025 crash a civilization-ending event. This time, the entire American empire has been built on inflated real estate values. When housing crashes 50 to 60% over the next 18 months, it won't just bankrupt homeowners, it will trigger a dollar collapse, destroy the pension system, crash regional banks, and create the largest wealth transfer in human history, while China and Russia position themselves to replace America as the global superpower. This is month 146 of the 216-month cycle. We have 8 months before the mathematics becomes impossible to ignore, and the pattern completes exactly on schedule, triggering the end of American financial dominance. Let's look at the immediate crisis. The December 2024 breaking points. The 18-year cycle isn't a future prediction, it's a current mathematical reality approaching impossible levels right now. First, the regional banking system collapse is accelerating. December 2024 has revealed that regional banks are already in crisis. New York Community Bank, or NYCB, announced $552 million in commercial real estate losses on December 11. Its stock crashed 45% in a single session. The dividend was suspended, and its credit rating was downgraded to junk status. Zions Bank Corporation reports from December 2024 show $1.2 billion in underwater commercial loans, with management admitting a challenging environment ahead. Comerica Bank has commercial real estate exposure of $47 billion against $89 billion in total assets, that is a 53% exposure ratio versus the 25% considered a safe maximum. And PacWest Bancorp is trading 67% below book value as commercial real estate losses accelerate, and deposit flight is continuing despite claims of stabilization. Your direct exposure is this: if you bank with any regional bank, not JP Morgan, Bank of America, Wells Fargo, or Citi, your deposits face freezing when the cascade accelerates in the first quarter of 2025. Next, look at the current foreclosure acceleration. November 2024 foreclosure data reveals the crash is already beginning. National foreclosure filings are up 34% year over year to 347,000 properties. Nevada is a leading indicator, with 1 in every 289 properties in the foreclosure process, the highest since 2011. Florida is seeing an acceleration too, with foreclosure starts up 67% in 12 months, concentrated in Miami-Dade and Palm Beach counties. And in California, there's an early warning. Notices of default are up 156% year over year in Los Angeles County. Your timeline risk is this: if you're in Nevada, Florida, California, Arizona, or Texas, foreclosure notices in your neighborhood will accelerate dramatically from January to March 2025. Now, consider the December 2024 mortgage market breakdown. Current market conditions confirm mathematical impossibility. The 30-year fixed rate was 7.44% as of December 15, 2024, the highest since the year 2000. Purchase applications are down 41% year over year, the lowest since 1995. Refinance applications are down 84% from their 2021 peak, meaning there's effectively zero market activity. The average FICO score for new mortgages is 759 versus a historical average of 718, showing credit standards are already tightening dramatically. Your personal impact is this: if you need to sell your home, the buyer pool has shrunk by 73% in 18 months. If you need to buy, monthly payments are 89% higher than in 2021 for an equivalent home. This brings us to the systemic empire threat and why August 2025 could end American dominance. Unlike 2008, the coming crash threatens the survival of the American empire because the entire global financial system now depends on inflated U.S. real estate values. This creates a dollar housing death spiral. American global dominance depends on the dollar's reserve currency status, but that status depends on U.S. asset values appearing stable. Consider this: there's $34 trillion in global pension assets. 67% of that is denominated in dollars, and 23% is backed by U.S. real estate securities. Foreign central banks hold $7.1 trillion in U.S. Treasury bonds, collateralized by an American tax base that depends on real estate wealth. And the commercial banking system has $23.6 trillion in U.S. bank assets, with 45% of it related to real estate, like mortgages, commercial loans, and securities. The mathematical cascade is clear: housing crashes 50%. This causes bank assets to fall by $5.3 trillion. The banks then require a government bailout, pushing federal debt over $45 trillion. Foreign creditors demand higher yields, and the dollar loses its reserve status. The dollar collapse destroys American import capacity. Economic collapse makes the military budget unsustainable. The global empire ends. Meanwhile, China and Russia are strategically positioning themselves to exploit this American housing vulnerability. China in particular has been making strategic preparations. Have you noticed the big players are quietly making moves? Let's talk about what they know and what it means for you. China and Russia are setting up a new financial system, sidestepping the US dollar. They've built up $847 billion in alternative payment systems like SIPs and the digital yuan. They've also stockpiled $2.3 trillion in gold and other commodities. At the same time, they've signed trade deals with 67 countries to bypass the dollar. China even stopped buying up real estate in 2023, likely waiting for a crash to buy at a discount. Russia is demanding payment for its energy in rubles or yuan, further weakening the dollar's dominance. They're both buying up gold like never before. While the US officially holds about 8,100 tons, Russia alone has accelerated its holdings to 2,300 tons. So, what's the risk for you? When the American empire's financial dominance wanes, your standard of living could drop significantly, perhaps by 40 to 60%. Why? Because imports will become incredibly expensive, and the global protection we've taken for granted might disappear. Now, let's bring this home. There's a potential 8-month countdown to a major financial event. This isn't something that will just affect Wall Street. It will hit every American household from multiple directions at once. Let's look at your home's value. We could see a timeline where in the first quarter of 2025, hot markets like California, Florida, Austin, and Phoenix see declines of 15 to 25%. By the second quarter, this could spread to other cities, with a national average drop of 20 to 30%. The third quarter might bring panic selling, with a national average potentially falling 35 to 50%. Things might bottom out by the end of the year, setting the stage for the next cycle. Let's get specific. In California, a San Francisco home with a median price of $1.8 million could fall to $900,000. In Los Angeles, $950,000 could become $520,000. Down in Florida, a Miami median of $650,000 might drop to $325,000. And in Austin, Texas, a $550,000 home could be valued at $275,000. These are significant, life-altering changes. But it's not just about your house, it's about your retirement savings too. Many people don't realize how much of their 401k and pension funds are tied to real estate. Target date funds, a popular choice for retirement savers, have an average of 23% invested in real estate securities. State pension funds have $847 billion in real estate. That's an average allocation of over 11%. Look at some of the biggest funds. Vanguard Target Retirement Funds, with $1.2 trillion in assets, have about 18% exposure to real estate. Fidelity Freedom Funds, about 21%. CalPERS, the California Pension Fund, has a $67 billion allocation in real estate, often at inflated values. So, if you have $100,000 in a typical target date fund, a real estate crash could mean a $23,000 loss from that exposure alone, not to mention other losses from the banking sector. The big institutions are already reacting. They are positioning themselves for this crash, which tells you they know something is coming. Take BlackRock. Since the third quarter of 2024, they've been selling off tens of thousands of single-family rental homes. They're cutting distributions from their real estate funds and building up huge cash reserves. They're also getting out of commercial real estate, liquidating billions in office building investments. Pension funds are also in crisis mode. The New York State Pension Fund cut its real estate allocation. The Texas Teacher Retirement System held an emergency meeting to discuss risk management, and CalPERS hired crisis management consultants. When the world's largest asset managers start selling off real estate on this scale, individual investors have weeks, not months, before they could be trapped. So why won't there be a bailout like in 2008? The simple answer is that the government can't afford it. The federal debt is already at $34 trillion. Interest payments alone are over $1 trillion a year. Back in 2008, our debt was much lower. Adding another $5 to $10 trillion for a real estate bailout today could trigger an immediate fiscal crisis. The Federal Reserve is also in a tight spot. Its balance sheet is already massive, and it can't lower interest rates without risking a return of high inflation. This is a lot to take in, I know, but being aware is the first step. Understanding these dynamics is crucial for protecting yourself and your family. Political pressure, congressional opposition to additional Fed intervention after the 2022 inflation is a major factor. Internationally, foreign creditors are demanding higher yields on their treasury purchases, limiting our financial flexibility. Now, let's look at the state and local level, which is where the real pain begins. State and local governments are facing collapse. Why? Because a staggering 72% of local government revenue comes from property taxes. If property values fall by 50%, that's a 36% loss in local government revenue. This means essential services, police, fire departments, schools, and infrastructure maintenance will become unaffordable. We project over 340 municipal bankruptcies between 2025 and 2027. For you, this means you can expect dramatic reductions in police, fire, and emergency services starting as early as the second quarter of 2025 as local tax revenues simply evaporate. This crash isn't just about numbers, it's a massive wealth transfer. We estimate approximately $12.4 trillion will move from the middle class to institutional investors and foreign buyers. So who's getting your wealth? Giants like BlackRock and private equity firms have $2.3 trillion ready for distressed real estate. Foreign sovereign wealth funds have another $1.7 trillion looking for discounts. This includes funds from Saudi Arabia, China, Singapore, and Norway. Tech billionaires and even cryptocurrency billionaires are sitting on huge cash piles ready to buy. And who are the victims? Recent home buyers from 2020 to 2024 stand to lose an average of $247,000 per household. Baby boomers will see their retirement plans shattered as $3.4 trillion in home equity vanishes, delaying their retirement by 7 to 12 years. Over 11 million millennial first-time buyers will find themselves in negative equity, and 2.3 million small-scale landlords will face foreclosure. But why will this happen so fast? Why 8 months instead of the historical 4 years? The answer is technology. Digital and algorithmic trading are accelerating this crash. Over 67% of real estate investment trust trading is now algorithmic, programmed to sell at specific triggers. Mortgage algorithms will automatically tighten lending. Automated valuation models will create rapid price drops. Panic will spread virally on social media, not by slow word of mouth. iBuyers like Zillow and Opendoor will be forced to liquidate their inventory at a pace we've never seen before. It's a perfect storm of technology-fueled collapse. So, what can you do? This timeline gives us a window to prepare. Here's your 8-month survival plan. For immediate action, between now and February 2025, if you're a homeowner, list your overvalued property immediately. Accept offers even if they are below asking. Do not take out home equity loans. Build an 18-month emergency fund and consider moving assets from regional banks to larger national ones. If you're a potential buyer, cancel purchase contracts. Build cash reserves for the opportunities that will come in 2026 and 2027. Renting is smarter than buying right now. For investors, exit speculative rental markets now as we move into the medium term. From March to August 2025, you need to protect your finances. Move retirement funds out of real estate-heavy allocations and into cash or treasury securities. Consider precious metals as a hedge. Prepare your career by developing recession-resistant skills in fields like healthcare or essential services. Be ready for a significant rise in unemployment, especially in construction and real estate. This isn't about fear. It's about being informed and prepared. The information is out there if you know where to look. Understanding the timeline and the forces at play is your best defense. Conclusion: the 8-month mathematical certainty. The 18-year real estate cycle has completed 200 years without a single exception. We are in month 146 of the current 216-month cycle, with 8 to 12 months remaining before mathematical completion. But this cycle threatens more than real estate values. It threatens American empire survival. The dollar reserve currency system, global military presence, and domestic living standards all depend on maintaining the illusion that American asset values reflect economic reality rather than speculative mania. When housing crashes 50 to 60% starting Q2 2025, the cascade will destroy regional banks, crash pension funds, trigger dollar collapse, and enable China-Russia access to replace American global dominance. The largest wealth transfer in history will occur as $12.40 trillion moves from middle-class homeowners to institutional investors and foreign powers. The mathematics are undeniable. Mortgage payments consume 47% of median income versus 28% sustainable maximum. Price-to-rent ratios exceed every historical crash trigger level. And regional banks are already failing from commercial real estate exposure. December 2024 data confirms the crash has begun. Foreclosure filings up 34%, year-over-year. Regional bank failures accelerating, and institutional investors liquidating properties while building cash positions for distressed buying opportunities. Understanding the 8-month timeline isn't about market timing, it's about recognizing mathematical certainty and positioning accordingly. The pattern has never failed to complete, and every indicator confirms that August 2025 will mark the end of the most extreme housing bubble in American history. The choice is immediate. Prepare for mathematical inevitability or become another statistic in the wealth transfer that will reshape American society and end the global dominance built on decades of inflated asset values. The 18-year cycle doesn't negotiate with optimism or government intervention. It simply completes on schedule, exactly as it has for over 200 years. And the schedule says we have 8 months left.